Hello everyone, welcome to Global Online. In today's lecture, we are going to see NTA UGC NET Paper 2 Commerce 2022 batch. This is a second lecture on Unit 2, that is Accounting and Auditing Unit. And in today's lecture, we are going to see the partnership accounts. Before we start with the lecture, I want to tell you that we the Global Online providing the course for the paper 1 in which we are providing you the daily life lecture, notes on all the topic, last 10-year question papers with a detailed explanation, test series covering 2500 MCQ with the detailed explanation. To get this, download our app Global Online or WhatsApp on this number. Okay, and the fees for this is 3500 rupees only. Students, we are also providing course for the UGC NET Commerce Paper 2, for which you have to download our app, that is Global Online, from your Play Store. Once you download the app, you have to register your number and go in the store and search for the UGC NET Commerce Paper 2. In this course, you are getting the complete video lectures on all the unit, notes on all the unit, test series, plus the previous year question papers with a detailed explanation and target based preparation. And if you are taking this course, the paper 1 you will get the free of cost. No need to buy the paper 1 separately. Okay, and the cost of this course is 7,000 rupees only. So now let's understand what is partnership. Partnership is defined in Section 4 of Indian Partnership Act 1932 as the relationship between the person who have agreed to share the profit of the business carried on by all or any of them acting for the all. Here the partnership is defined under Section 4. Please remember the section and the act, that is a 1932. Okay. The partnership means the relationship between the two persons. It is an agreement between the two or more people where they are agreeing to share the profit, where they are doing a business together, and on this they are making the agreement to share the profit and loss for the business. Okay, that is called a partnership. There is a partnership deed. A contract for a partnership need not necessarily be in the writing, although it is advisable to reduce it in the writing to minimize the dispute among the partners. Okay, it is not necessarily or it is not compulsory that it should be in written format, but it is advisable. Why it is advisable? To minimize the dispute among the partners. Okay, but when the contract is put in the black and the white, the written contract is called a partnership deed. It is a legal document signed by all the partners. Okay, when we are making a contract on the paper, means when we are writing the contract with the black pen on the white paper, that is a written document, and that paper, that agreement is called a partnership deed, and we consider it is a legal document which is signed by all the partners whoever are involved in that partnership. Okay, it is a mostly content with the name of the partner, name of the firm, nature of the business to be carried on by the firm, the power of the partner, when the termination is certain, the term of the duration of the partnership, the amount of a capital to be contributed by each partner, the restriction on the working capital of the each partner, the method of the division of the profit and the loss, how they are going to share the profit and the loss, how much will be the salary, how much will be the commission, interest payable to the partners, interest on the drawing to be charged on the withdrawal, interest on the loan payable to the partner, valuation of the goodwill when there is a change in the constitution of the firm, the method of the accounting, and the attribution clause. Okay, all these things will be included in the partnership deed. Okay, means the name of the partnership, the firm, how much the ratio they are going to share, how the profit is going to be distributed among the partners, how will be the interest. Okay, all these things will be there in the partnership deed. Then is a reconstitution of the partnership. Now what is a reconstitution? When there is any change in the existing agreement of the partnership, it is a reconstitution of the partnership. Means whenever we are making any change in the previous agreement which we are having with ourselves, that time we are saying that it is a reconstitution of the partnership. As a result of a reconstitution, the existing agreement of a partnership comes to the end and a new agreement is the formed. Whenever we are making some changes to the previous agreement, that time that agreement comes to the end and we are forming the new agreement. There might be several reasons for the reconstitution of the partnership firm. The first reason is the change in the profit sharing ratio. The profit sharing ratio is a ratio where the partners are sharing the profit with themselves. That ratio is called a profit sharing ratio. Whenever we are making a changes in the profit sharing ratio, that time the reconstitution of a partnership can be happen. The second reason is admission of the new partner. Admission of the new partner means that whenever the new person is getting admitted into the partnership, okay, that time the reconstruction of a partnership can be happen. That is a retirement of the partners. Now why the person is getting retired? Maybe because of the age, maybe because of the health condition. That time the reconstitution of the partnership can be happen. And last reason is death of the partner. If somebody die because of the accident or maybe because of the some other reason, that time the reconstitution of a partnership can be happen. So please here remember these reasons, because in exam you might receive the question on this. The another important topic here is sacrificing ratio. Please understand this because you might receive the practical question on this topic. Okay. In partnership business, when the partner is admitted into the firm, the old partner have to surrender a portion of their share of the profit in favors of a new partner. Whenever the new person is getting admitted, whenever the new person want to come into the partnership, that time the old partners who are there in the partnership have to surrender some portion of their share of the profit, because the new partner will also get the some amount of the profit, right? And because of that, the old partner have to surrender some portion of their shares of the profit. Sacrificing ratio is the difference between the old profit ratio, sharing ratio, and the new profit sharing ratio of the old partners. Okay. Here we will see the example of sacrificing ratio. The example is if the A and B share the profit in the ratio of 5:3 respectively, and the admission of the C, the new ratio among the A, B, C is agreed upon 7:5:4 respectively, the ratio of a sacrifice will be calculated as the follow, for which we have to see how much A is sacrificing. For this the formula is sacrifice by A equal to A's old share minus A's new share. The old share of the A is 5 divided by A, 8, and the new share is 7/16. So here we have to make a denominator same. For this we are multiplying the 5 multiplied by 2 and 8 multiplied by 2. The answer is 10 divided by 16. So when we minus 10 from 7 from 10, we are getting 3. That means the sacrifice ratio of the A is 3/16. Then we see the sacrifice by B. Old share minus the new share, that is 3/8 minus 5/16. We are getting 1/16. Hence the sacrifice ratio of A and B will be 3:1. Then is the gaining ratio. On the retirement of the partner, the share of the profit to the other partners increase. Okay. Whenever the person is getting retired, his share will be distributed among the old partner. That means the old partners, whoever are there in the partnership, will get the more shares of the profit. In order to find out the ratio in which the remaining partner have a gain, the old share should be deducted from the new share of the remaining partners. We will see this with the example. Here the example of gaining ratio. If the A, B, C share the profit and the loss in the ratio of 7:5:3 respectively, and after the B's retirement, A and C decided to share the profit and the loss in the ratio of 3:2 respectively, then the ratio of the gain will be calculated as the follow. We have to see how much the A old share is, that is 7 divided by 15, and A's new share is 3 divided by 5. The gain whatever the A is getting is new share minus old share, that means 9 minus 7 divided by 15. The new share or a gain whatever the A is getting is 2 divided by 15. Then is C. His old share is 3 divided by 15 and his new share is 2 divided by 5. The gain whatever C is getting is new share minus the old share, that means 6 minus 3. The gain whatever C is getting is 3 divided by 15. That means the ratio or a gain between the A and C is 2:3 respectively. This is the gaining ratio. Then is a memorandum revaluation account. What it means? A new partner is not be benefited by any appreciation in the value of an asset of the firm or by any decrease in the value of a liability of the firm. Therefore, before a new partner is admitted, the assets and the liability of the firm are revalued, and any profit or a loss resulting from such a revaluation is transferred to the old partner's capital account in the old profit sharing ratio. What it means? Before we admitted a new partner into the partnership, we are doing a revaluation of the assets and the liability whatever are there in our business. Now why we are doing this? So that any partner who is getting admitted will not get any benefit if there is a appreciation or an increase in the value of the assets of the firm, okay, or will not suffer because of the decrease in the value of the liability of the firm. Whatever the profit or the loss we are getting from the revaluation of the assets and the liability, we will share that loss or the profit amongst the old partner in the old profit sharing ratio. That is called a memorandum revaluation of the account, which we are doing before we are admitting a new partner into the partnership. Dissolution of the firm. Dissolution of the firm means that the business of the firm is put to the end. The assets are disposed of and the liability are paid off, and the account of all the partners are settled. In the dissolution, the firm is going to be a wind up, okay, means the shutdown. So all the assets whichever are there are disposed of, the liabilities are paid off, and the account of all the partners, whoever partners are there in the partnership, their account will be settled. Then is the dissolution of the partnership. A partnership is dissolved on the expiry of the term or on the completion of the specific venture, death, retirement, or the insolvency of the partner. When the partnership is getting wind up or when the partnership is getting to the end, when there is a expiry of the term, whatever the agreement we have made is getting over, or on the completion of the specific venture, or on the death, if somebody die, means the partner die, then it can be a dissolution of the partnership or the retirement or the insolvency of the partner. However, if the remaining partners decide to continue to run the business, the partnership is not dissolved. If somebody die or somebody retire, but still whoever are there in the partnership, they decided to continue to run the business, then the partnership of the firm will not dissolve. Okay, they can continue. If they do not continue, then the firm is also dissolved automatically. If the partnership is getting over, if the partners decided to wind up, then the firm will also dissolve automatically because there will be a no partner, right? So that means the firm will not remain in the existence. The one of the most important topic under this unit is a depreciation, because from this topic you might receive the question during your exam time. So here the depreciation is the process of allocating the cost of the fixed asset over its estimate useful life in the rational and the systematic manner. Okay. The business enterprise acquire a different type of a fixed asset. To do a business, the businessman will acquire a different types of the fixed asset, right? To run a business, the businessman require the different type of a asset which he will take from the market or he will buy from the market. Whenever the asset is used in the business, its a value get reduced and sooner or later the assets become useless. For example, if you buy a car for your personal use and the cost of the car is rupees 10 lakh for this year, can the value of the car will remain the same for the next year? Then the answer will be no. Because after we use that car, the value of the car will reduce because we already use that car, right? Depreciation is a permanent, continuous and gradual in the book value of the fixed asset. The one of the important method under the depreciation is the fixed installment method or a straight line method. Under this method, the fixed portion of the original cost of the asset is written off every year. You have to remember the formula here. The depreciation equal to the original cost of the fixed asset minus the estimated scrap value divided by the life of the asset in the number of the year. Now how we can find out the percentage of the depreciation? Then the formula is depreciation multiplied by 100 divided by original cost of the fixed asset. Please by heart this formula. Diminishing balance method or reducing balance method. Under this method, the depreciation is calculated at a certain percentage each year on the balance of the asset which is brought forward from the previous year. The amount of a depreciation charge for each year is not fixed, but it goes on the decreasing gradually as the opening balance of the asset in the each year will reduce. Supposing this year we are reducing the 10% depreciation, so next year it might be a 8%. Okay, every year it is decreasing 10, 8, like 6% next year, like this. Okay, for this the formula is depreciation equal to 1 minus square root net residual value divided by cost of acquisition. The rate of depreciation equal to 1 minus n. Now here the n is life of the asset in the years, the number of years. Sum of years digits method. In this method, the charge for depreciation on the accounting period is calculated in the portion of remaining life of the asset at the beginning of the every accounting period. Depreciation goes on decreasing every year. Okay. For this the formula is depreciation equal to remaining life of the asset including current year multiplied by cost of the asset divided by sum of the digit of the life of the asset in the years. So today we have discussed about the partnership account, the partnership deed, sacrificing ratio, then is a gaining ratio, then is dissolution of the firm, dissolution of partnership, then is the admission of the partner, retirement of the partner, reconstitution of the partners. During our next lecture, we are going to see about the company share, the forfeiture of the shares, the reduction of the shares. Okay, so don't miss my next lectures. Till then, keep watching, keep learning.